Have you ever felt lost when people talk about the stock market? Well, you're not alone. In today's English lesson, we'll discuss stock market jargon. Whether you're a beginner or just looking to improve your financial vocabulary, this is the perfect lesson for you. We'll explore both positive and negative terms frequently used in the stock market. I'll break it down in simple, easy-to-understand language. I am Sarah. Hit like and subscribe to the channel so you don't miss useful lessons like this one. By the end of this video, you'll not only know what these terms mean, but also be able to use them confidently in real conversations. First, let's look at the negative words related to the stock market. Here's the first one, bear raid. Now, when a group of investors try to drive down the price of a particular stock, they might do this by selling a lot of shares of that stock very quickly, which makes it look like the stock is not valuable. They might also spread negative rumours about the company to scare other investors into selling their shares. When many people start selling, the stock price falls. In short, a bear raid is an aggressive strategy to push down the price of a stock through heavy selling and negative rumours. Here are some examples. In the US, some smaller tech companies have been victims of bear raids, affecting their stock performance. A bear raid can cause panic among investors, leading to a sharp decline in the stock price. I hope you got it. Here's the next one, burned out. Now, in literal terms, it means to be exhausted doing something over and over, like a boring 9-to-5 job. But related to stock market, it means a stock or sector that has experienced significant declines and is no longer considered a good investment is said to be burned out. People avoid buying those stocks. Let's look at some examples. Some tech stocks became burned out after their initial hype faded away. In the Indian market, certain real estate stocks are seen as burned out after years of poor performance. With that, let's move on to the next negative term, bag holder. In the stock market, someone is called a bag holder who stays invested or hold a stock that has dropped significantly in value, hoping it will recover someday. It's more like having negative optimism. Here are some examples. Despite the stock's continuous decline, the bag holder refused to sell, hoping for a rebound. In the US market, some cryptocurrency investors have become bag holders after the recent price drops. Well, let's move on to the next one, whipsaw. In the stock market, whipsaw refers to a situation where the price of a stock or an investment moves sharply in one direction and then quickly moves in the opposite direction. This means that the price first rises a lot and then falls a lot, or it first falls a lot and then rises a lot. This can cause investors to lose money because they might buy or sell at the wrong times. It's like a seesaw that suddenly goes up high and then quickly comes down. I hope you got it. Take a look at these examples. In the Indian stock market, whipsaw movements were seen due to conflicting economic news. Whipsaw movements can be frustrating for traders as they make it difficult to predict market trends. I hope that was clear to understand. Here's an interesting one, zombie stock. Now, a zombie stock refers to a company that continues to operate despite being financially troubled. or has very low chances to pay their loans or debt. Zombie companies often have just the money to survive. The term zombie is used because, just like zombies, these companies are not really alive in the business sense, but they also haven't been shut down. Let's check out some examples. Many investors avoid zombie stocks because they see little potential for future returns. After the stock market crash, several retail companies turned into zombie stocks, barely surviving. I hope you got it. Next, let's talk about junk bonds. A junk bond is a risky type of loan given to companies with low credit ratings. These companies offer higher interest to attract investors who are willing to take a chance for more profit. These bonds have a higher chance of not getting paid back compared to safer bonds. Simply put, it's like lending money to a company with a bad credit score, and they promise to pay you back with extra interest because of the risk. Let's look at some examples. The struggling retail company issued junk bonds to raise money, offering high interest rates to attract investors. Junk bonds are popular among investors looking for high profits, even if it means taking on more risk. I hope you got it. Let's move on to the speculative bubble. A speculative bubble is a situation in which prices of assets, such as stocks, real estate, or other investments, rise rapidly and reach levels far beyond their actual value. This happens because people keep buying the asset, expecting its price to continue increasing. However, the bubble eventually bursts when people realize the prices are too high and start selling off their assets, causing prices to drop quickly and the market to crash. This, unfortunately, causes a lot of people to lose money. Here are some examples. Many investors lost their savings when the dot-com speculative bubble burst in the early 2000s. During a speculative bubble, people often buy assets at inflated prices, expecting to sell them for even more. So these were negative terms related to stock market. Knowing these terms will help you make more informed decisions and navigate the stock market efficiently. Now, let's move on to the positive terms related to the stock market. These will help you make good investments. The first positive term is bull market. In the stock market, a bull market is a period in which stock prices are rising or are expected to rise. This term is commonly used to describe a positive upward trend in the market. During a bull market, investors' confidence is high, leading to increased buying activity. In short, it means the market is doing well and people are generally feeling positive about investing. Let's look at some examples. In a bull market, the overall economy tends to improve as consumer confidence and spending increase. Analysts predict that the current bull market will continue as long as the government is stable. The next term is blue chip stock. These are shares of large, well-established and financially sound companies with a history of reliable performance and stable earnings. For example, Apple, Google, or Reliance Industries. They are considered safe investments. They are often leaders in their industries. Here are some examples. Investing in blue chip stocks like Apple and Microsoft is often seen as a safe bet for long-term growth. Johnson & Johnson is a blue chip stock due to their consistent performance and financial stability. I hope you got it. Moving on, the next term, high flyer. Now, you must be thinking that this has something to do with a person who is ambitious, right? That is right. But today, we are discussing stock market terms. So in the stock market, high flyer is a stock that shows a strong performance, often with rapid price increases and significant growth potential. These stocks are usually from companies that are experiencing fast growth and innovation. Basically, it is a stock or company that has grown quickly and could make a lot of money. But you have to be a little careful with them, as they are often volatile and carry a high risk. Let's look at some examples. Nvidia has been a high flyer in the stock market, with its share price soaring because of its innovation in AI. Investing in high flyers can be lucrative, but also comes with higher risk due to their volatility. I hope that was easy to understand. Up next is the word rally. Now, in a stock market, rally is a period during which the prices of stocks, bonds, or other assets see a sustained increase. It is often driven by positive news, strong economic data, or increased investor confidence. Let's check out some examples. The stock market experienced a rally after the release of positive economic data by the government. A rally in the tech sector stocks boosted overall market performance. Quite an interesting term, right? Moving on, the next term is riding the wave. Riding the wave in the stock market means taking advantage of a rising trend in stock prices. An investor buys stocks during a rising trend to profit from increasing prices. It's about going with the flow of the market while it's moving upward. Here are some examples. Investors who bought tech stocks early are riding the wave of rising prices. She decided to ride the wave of the bull market and bought more shares. That brings us to the next term, which is healthy correction. Now, a healthy correction is a temporary, short-term decline in stock prices following a period of rapid gains. Corrections in the stock market are necessary to prevent market from leading to a bubble. This ensures long-term stability of the stock. They allow the market to consolidate gains and provide better buying opportunities for investors. Let's look at some examples. After months of rapid growth, the stock market experienced a healthy correction, which is normal and expected. Investors shouldn't panic during a healthy correction. It's a natural part of the market cycle. And lastly, let's talk about value investing. Value investing is a strategy where investors look for stocks that they believe are undervalued by the market. This means they find companies that are worth more than their current stock price. The goal is to buy these stocks at a low price and hold onto them until the market realizes their true value, which should make their stock prices go up. In simple terms, it's like buying something on sale and waiting for its price to rise to what it's really worth. Here are some examples. Warren Buffett is famous for his value investing approach, focusing on long-term gains. Through value investing, he bought shares of a solid company at a bargain price. There you have it, the positive and negative terms related to the stock market. Understanding these terms can greatly enhance your financial vocabulary and give you more confidence when talking about the stock market. If you found this lesson helpful, please like and subscribe to the channel so you don't miss out on future lessons. Knowledge is power, especially when it comes to finances. Thanks for watching, and see you in the next video. I'm Sarah, signing off.